Gold is going crazy. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a surprise tariff. Gold futures jump as the U.S. confirms it is putting levies on imports of bullion bars. Meanwhile, President Trump's surprise pick for Fed governor buys him time to focus on the next Fed chair. And on the corporate front, 10 stocks have driven 80% of the S&P's rally since Liberation Day. No surprise that we're looking at real concentration here.
Yeah, absolutely. Let's talk a little bit more about tech here. We're taking a look at Meta. It announced financing for a $29 billion data center expansion. You also have Tesla disbanding its Dojo supercomputer team in a blow to its AI ambitions. And Intel CEO says that he has support from the board in a rebuff to President Trump's call for him to resign. What's interesting to me, Matt, is that these are pretty muted moves overall. Intel is the most dramatic move. I would have expected Tesla to be down a little bit more.
Yeah, me too. But you know what? That stock trades on something else than fundamentals. We are watching gold-related stocks as the U.S. says gold bars above 1 kilo are subject to reciprocal tariffs. That could disrupt shipments from Switzerland and other key trading and refining hubs. You can see Barnes Group, Newmont Mining, and WPM all rising in the pre-market trade. Joining us now is Bloomberg Swiss Bureau Chief Jan-Henrik to talk about this. And Jan, I guess the idea is that a lot of traders here in the U.S. thought that these tariffs on Swiss goods wouldn't be applied to gold because you need to trade 400-ounce bars for central banks, 100-ounce bars for the COMEX, and kilo bars in Asia. Apparently, there are going to be tariffs on those gold bars.
Exactly. That's what they thought. They had plans, and then they got a letter. I have the letter here. So basically, maybe just one step back, Switzerland has a big trading surplus with the United States. It's not because of chocolate, not because of watches, or really anything else. It's because of gold. Switzerland, as you said in your intro, is a main refining hub. So it comes over from London, from Uzbekistan, from wherever, and then it's being shipped to the US market, mainly to back future contracts, right? And the idea was this is exempted from tariffs. A gold refiner from Switzerland sent a letter to the US Customs Office and wanted to get clarification on it. And, so I'm having this letter in front of me, it talks about gold bars. The gold kilobar is rectangular in shape, 115 millimeters in length and 50 millimeters of thickness, that kind of stuff. And then they clarified the tax code, which is now 7108135500. That is a tax code for gold bars, which are being shipped to the United States, and they fall under the 39% tariffs for Switzerland.
Right.
And that's also true, by the way, for all the other countries.
Yeah, and it's just dizzying to think through the implications of this. You think about even central bank reserves. This would touch really a lot of different areas. But what's interesting to me is that there was some pull forward here. This specific letter that you have in your hand is a surprise. But you think about U.S. monthly gold imports surging to a high of 43 tons in January this year alone. The average monthly production by gold refiners in the U.S. is 22 tons, according to last year's average. So there was some anticipation that maybe something was coming. Yes.
I mean, the immediate consequence is it's a small industry at the end of the day, for instance, here in Switzerland. Shipments are on hold now, right? So U.S. producers or refiners, they need to get, the raw material from somewhere else. And prices in the U.S. are rising, while there's a massive arbitrage opportunity or situation, while prices in Europe are lower. So I feel like people are now trying to find out what the fallout from this is going to be and how they can replace those shipments. The only thing I can tell you from a European perspective right now is that all shipments are on hold. So basically there's no trading of gold bars between the Atlantic. So I guess that we can call that a massive disruption to global gold trade. And then I don't know what the implications for central banks will be, but there should be implications.
Yeah, and I'm also thinking through the implications of physically backed gold ETFs. I won't ask you about that, though. I know you have a busy day behind you and ahead of you. That is Bloomberg's Jan-Henrik Forster joining us from Zurich. And be sure to tune in on Monday. We will be joined by Barrick Mining CEO Marc Bristow, and we will certainly have a lot of questions for him. But let's turn to tech right now, because Tesla disbanding the team it said last month that it was doubling down on. Joining us now is Bloomberg Tech co-host Caroline Hyde. And Caroline Hyde, we're talking specifically about the Dojo supercomputer team. Certainly a blow to their AI ambitions here. What do we know so far?
Well, Elon Musk is trying to explain this, that ultimately they were going in two directions when it came to hardware manufacturing, chip manufacturing, and basically it didn't make any sense. Bring them together. Now, we know that they just had that deal to be creating their A16. This is their sort of more modern architecture for chips going forward. That's going to be done with the likes of Samsung as well. They're going to be securing yet more investment in their chip hardware. And so why have Dojo? Why have this supercomputer project going on, which has been going on for years, which in fact, Morgan Stanley back in 2023 thought would add to the valuation of Tesla by $500 billion. The idea being going that they use NVIDIA less, they use AMD less, Samsung less, and they build their own hardware and their own chips. But now I think Elon Musk is saying that's proving very hard. Paul Bannon is leaving. They've got some other startup starting to take all of their talent. Why bother with that? Why not depend more on third parties to make your chips, and you concentrate actually on the data that's going in and the application of those chips within Teslas and full self-driving?
They're clearly not getting them from Intel. And, yesterday, President Trump demanded Lip-Butan's resignation at Intel. Today, Lip-Butan apparently has sent a letter to employees saying he has full support of the board and he wants to clarify things with Washington. But the Wall Street Journal says the board actually has problems with him.
Well, it's interesting. He was on the board, remember, when he was still Cadence Design CEO.
I mean,
he was
other
on the
members
board
of the
Intel, and they know him, though.
Yeah.
And they should have done these background checks. They should understand the implications of the fact that he used to be on the board of SMIC, which is one of the biggest Chinese semiconductor manufacturers. More broadly, he's saying there's a lot of misinformation circulating about his past roles at Walden International and Cadence Design Systems. Walden International, I mean, on the Bloomberg terminal and on its own website, he's still listed as founder and chairman. So has he distanced himself from that VC company in Singapore, which has made many bets on Chinese companies? That's what really needs to be articulated here. But he is trying to make the point that he has been living in the United States for a very long time. Remember, he's of Malaysian descent. And he's committed to the strategic and national security implications of his role at Intel. I thought there was a nuance in the letter as well, really saying, I'm excited to manufacture the greatest, most innovative software chip design here. Well, I thought in the earnings they were sort of backing away from the fabrication. So I wonder where that nuance goes. Do they want to hear more about manufacturing here in the United States? Because that's kind of the political imperative.
All right. A lot to talk about on tech, and we look forward to your program. Caroline Hyde co-hosts Bloomberg Tech at 11 o'clock, and there is a ton going on there, including a big Meta deal. A group of 10 stocks, though, including Meta, have powered a vast majority of the S&P 500's 12% rally since April. The Mag 7 plus Broadcom, Oracle, and Palantir accounted for 80% of the S&P 500's return since Trump's Liberation Day in April, according to B of A strategist Michael Hardnett. Let's discuss with Bloomberg's equities reporter, Alex Semenova. So, real concentration here.
Yeah, it's unbelievable. We are in the final stretch of the reporting season. Roughly 90% of S&P 500 companies have already reported results. And one undeniable takeaway has been that big tech is driving the lion's share of profit growth. The Magnificent Seven stocks grew earnings by about 26% year over year in the second quarter. That's compared to just 4% for the remaining constituents. This is according to Goldman Sachs data. So really showing the strength of their balance sheets, their profit growth. And Goldman actually said that the tailwinds coming from these companies have been enough to balance risk in the S&P 500 at a time when there's so much uncertainty over the macroeconomic outlook. You guys mentioned that 10 stocks accounted for 80% of the rally. And something interesting Barclays flagged is that when we got that weaker labor data on Friday, that concentration grew even more. Investors flocked to big tech, so really showing that investors are counting on the reliability of these companies.
And what's interesting to me is that it's not that big tech is insulated from tariffs. I mean, you think about some of the chip makers, too, really in the crosshairs of these trade negotiations. It's just that it doesn't seem to be impacting their earnings in the same way as maybe companies that more physically make things? I'm thinking about retailers, for example, maybe some of those consumer staples names.
Yeah, those AI companies, they have not pulled back on spending at all. If you look at some of the news today, TSMC, the go-to chip maker for NVIDIA and AMD, reported 26% revenue growth in July, closer to home. Meta picked Pimco and Blue Owl to lead a $29 billion financing for its data center expansion. So these companies still spending on AI, and a lot of investors counting on this capital expenditure to materialize in their earnings results. Going into the earnings season, BlackRock flagged that the hyperscalers, Microsoft, Amazon, Alphabet, have increased CapEx guidance to a collective $300 billion in 2025. Tony Kim over there said that AI is not just a buzzword, but it is the most enduring and dominant theme. And I think that's what's driving this rally here.
It also helps that all the big tech companies are just spending money on each other. It's just like
It's like a continuation fund.
Exactly, like an Ouroboros or something. Alex, great roundup. Really appreciate your reporting. That is Bloomberg's Alex Semenova. Let's take a check on this market as we count down to the opening bells on this Friday morning. A little bit of green on the screen. The S&P 500 up by about 0.2%, a little bit less if you take a look at the NASDAQ 100. Russell 2000, your small caps outperforming this morning. Of course, it feels like what we're talking about at the setup at the start of the day never actually holds through the closing bell. So
because so much happens throughout the day, right? I mean, there are headlines continuing to come in. I think it's fantastic, for our industry.
Right.
But there are obviously a lot of movers throughout the day and a lot of things changing. Some big. Some small.
Yeah.
Real, for example, is a $600 million company. But it's part of the zeitgeist right now, and the shares are absolutely surging. It could be $1 billion company by the end of the session because it boosted guidance on strong earnings.
Yeah.
Have you used the Real
I have.
to buy stuff?
Actually, I've bought stuff and I've sold something on the Real. And maybe that's why you see that 29% pop. Probably not, and we'll see how the market cap changes, but that's one of the companies that reported after the bell yesterday. So too did Under Armour, falling as its weak outlook weighs on turnaround efforts, dragging shares down by 18.5%. Haven't really shopped at Under Armour lately.
No, I've never gotten anything there. Trade Desk is also down as the ad tech company sees competition from Amazon. They trade with the big guys, and there's a lot of competition there. So, but losing a third of your value in one day.
They also announced a CFO change after the bell yesterday. So a corporate shakeup along with those results that underwhelmed.
Coming up, President Trump picks a new temporary governor for the Fed's board. We'll explain what that means next. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Sweetgreen is slashing its sales guidance after a second straight quarter of disappointing results. The data highlights the salad chain struggles to sell $15 salads to budget-strained diners, and actually they end up always costing more. Sweetgreen is also discontinuing its Ripple fries because of the complexity that adds to kitchens. Meanwhile, Wendy's is cutting its sales guidance after posting a bigger than expected decline. The result highlights economic pressure weighing on the chain as diners apparently cut back at orders there as well. And Expedia is raising its full-year sales guidance after reporting strong second quarter bookings. The report was fueled by its enterprise business and improved demand from U.S. consumers as well. The upbeat outlook comes despite signs that travelers are becoming more cautious when planning travel. Katie?
Let's turn over to the Fed because President Trump has made his pick to fill Governor Adriana Kugler's seat. His nomination goes to an economic ally, Stephen Miron, chair of the White House Council of Economic Advisors. Let's discuss with Bloomberg's international economics and policy correspondent, Michael McKee. So, Mike McKee, you think about how long he might actually spend on the Fed board. Wells Fargo estimates that he could just have 2 meetings under his belt until his term expires. So maybe that dampens how much influence he might actually have.
And he probably wouldn't have a whole lot of influence anyway if he's seen as a short-termer, because the Fed will go on and he would not. So why would people necessarily listen to him? You've also seen this switch semi-switch of Fed officials in the last week saying maybe we are open to a move lower at the next meeting. And if the Fed decides as a group, a majority, to cut rates, then Myron adds nothing to the debate. So it may be that the president just wants somebody who can make public speeches or be a goad to Jay Powell or something like that. But unless he nominates him for a full term, he isn't going to have a whole lot of influence at the Fed.
It makes sense that the president would put somebody in this spot until Kugler's term ends in January, because then he has full optionality, right? He can either choose somebody from the board to replace Powell, or he can choose someone completely new to fill that seat and then replace Powell. But it means that he's going to have 2 more Senate confirmations after Stephen Myron's now.
Yes, and
potentially.
You never know what's going to happen, but I think this Republican Senate would give the president pretty much what he wants if it's not a real outside-the-box choice. But in the past, we haven't seen a temporary Fed governor before. In the past, what's happened is they've just left the seat empty until the term is up and then confirm somebody to a new term. There wasn't seen to be much point in having somebody serve for just a couple of months. And I suspect if you're Stephen Myron, you've gone to the president and say, well, yeah, I'll take the job, but I'm not going to go for 2 months and come back and have no guarantee that I get my old job back.
Right, fair enough there. So that's the latest on the horse race over at the Fed. Let's talk about what's going on in the gold market. That was the shock overnight that the U.S. is moving to put tariffs on imports of gold bars. We were discussing in the commercial break that this was part of the trade negotiations and the trade discussions at the beginning of the year, and now it's back in the conversation in a big way.
Yeah, when Trump was elected and talking about putting tariffs on anything coming into the United States, gold holders rushed gold into the U.S., 43 tons of it in January alone. Basically, they, in the first quarter, sent in double what they had sent in the prior years because they wanted to get ahead of tariffs. And then when Trump did not do the tariffs and put everything off, everybody breathed a sigh of relief, and a lot of that gold flowed back out again. And so all those traders, I'm sure, are slapping their foreheads going, oh, thanks.
Yeah.
And, so it's distorted the trade statistics and has made it a little more difficult to figure out what's going on in the economy. At the same time, apparently going to cost a lot of gold traders money.
Absolutely. Also comes at a time when gold was already trading near a record high. So now you add tariffs on top of that, and that supply-demand picture gets a little bit even crazier. Mike McKee, really appreciate the insight. That is Bloomberg's Michael McKee. And we are about 10 minutes away from the opening bell. Quick check on futures as we count down. The S&P 500 a little bit higher right now, a little bit higher when it comes to big tech, despite all the drama underneath the surface, and a little bit higher, a little bit more when it comes to those small caps. We'll take you through all the action up next with JPMorgan's Sitara Sundar, who sees near-term pain but long-term gain for stockholders. This is Open Interest. Investors are pulling money from U.S. stocks and putting them in cash funds as the S&P 500 rally stalls. Bank of America's Michael Hartnett says that U.S. stocks saw nearly $28 billion in outflows following last week's dismal jobs numbers as a slowing economy and tariffs lead investors to take profits with stocks near all-time highs. Let's discuss with Sitara Sundar. She is head of alternative investment strategy over at JPMorgan Private Bank. Great to see you in person on a Friday.
Nice to see you too.
So let's talk about that. Bank of America is seeing this rush back into cash, basically people taking profit here. Does that fit with your view of the world and where the market currently is?
So it's an interesting start to the year. I mean, really, I say start to the year, but it's already August.
Yeah.
But we've seen a couple of different dynamics take place where this push and pull between what is happening in the economy versus what's happening in the markets. But we're still constructive. We actually just raised our mid-year target for next year, and we still see single-digit upside, mid-single-digit upside from here. And the reason for that is because earnings growth has been quite strong. And we always talk about how the markets and the economy are not the same thing, and we're starting to see that play out. And just take a look at this latest earnings season. Earnings beat pretty handily. It was a low bar, to be fair, right? Consensus came in expecting less than 5% year-over-year earnings growth for the quarter, and we're tracking near 10 or 11%. But the interesting point is that earnings growth has not just been technology and the boost that we're seeing within artificial intelligence, but financials, comm services. We're seeing a little bit of breadth in that earnings growth. So when we think about our outlook moving forward, we're still constructive, not just because earnings growth has been resilient, but because the areas of the market that we anticipate kind of pushing forward in that earnings growth is starting to broaden out too.
So expand on that. Where is it broadening out to? Because as we have been talking about this morning, 80% of the gains that we've seen since April are driven by 10 stocks.
Yep.
Now, if earnings growth is driven by more than that, then I guess you can deduct that the market isn't rewarding many other stocks for the kind of growth that you're expecting to see. Which are they?
So financials is a big part of it. I think financials is one of the biggest sectors within the S&P 500. We're seeing a couple of things in terms of not just bank earnings being better than folks were anticipating, but even when we look at the future outlook, there's a couple of secular tailwinds that are coming and giving some credence to the financials case as well. One, our expectation that the yield curve is likely going to steepen as the short end comes down and the long end stays anchored. Two, the deregulation and deregulatory impulse that we're expecting to see in the second half of this year and early next year. And then three, perhaps equally importantly, is the reopening of capital markets. We're starting to see a pickup in IPO activity, M&A activity, and that's positive not just for financials, but private markets as well.
Right. It certainly feels like the IPO market has opened in a big way, even in the depths of summer. Sitara, you're sticking with us through the opening bell. Here's a quick check on the setup as we count down. A little bit of green when it comes to the S&P 500. The open is up next. Don't go anywhere. This is Bloomberg.
We're moments away from the start of trading on this Friday. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are in the green, 0.3% on the S&P. NASDAQ futures up a little bit less today. Now, that's what we saw yesterday, and we closed down. And it does seem like a lot of these days we open up positive, investors buy the dip overnight, and then we close down when the session ends, when Romaine comes on at the close. Vantage Corp ringing the bell at the NYSE. I'm not blaming Romaine.
No,
by the way.
no.
I'm just saying that's what happens. And Avid Bank ringing the bell, AVBH down at the NASDAQ. There are, once again, a ton of stocks to watch. Earnings stories, a lot of personnel stories today, some funding stories, and I'm seeing all of those represented here.
Yeah, I mean, these actually aren't huge moves. There's a lot of big moves in this market, and you're not going to find it in the tech stocks. But that's what's interesting, because we actually have news about the names behind me. You have Meta announcing financing for a $29 billion data center expansion. You have Tesla disbanding its Dojo supercomputer team in a blow to its AI ambitions. You think about what Tesla says the future is. They say AI. You can see the stock not really reacting, though. And then you have Intel CEO saying that he has support from the board in a rebuff to President Trump's call for him to resign. Intel shares up slightly on that news, Matt, only about 0.7%.
All right, we're also watching gold-related stocks as the U.S. says gold bars above 1 kilogram are subject to reciprocal tariffs. Wait, could you just order then gold bars below 1 kilogram and get around that? If you get enough, that is going to represent one.
There's definitely an arbitrage here.
It could disrupt shipments from Switzerland is the idea here, because it is one of the major trading and refining hubs of the world, and we trade those 1 kilo bars, apparently 100-ounce contracts, 400-ounces for central banks.
Someone.
No, I'm just I'm deep into this story. I've been all over it with the COMEX this morning.
I know, yes.
We are back here with Sitara Sundar, head of alternative investment strategy at JPMorgan Private Bank, and as Katie pointed out, you know, gold had already been doing very well. We had viewers writing in this morning asking if people were front-running potential tariffs. And indeed, it looks like that's what's happening. Have you advised clients to hold gold in portfolios?
It's been one of our highest conviction calls, honestly, for the past couple of years, and we still expect upside from here. And I would broaden the conversation out. in terms of what we've been talking to about clients, one of the things that has resonated the most with gold is not just in terms of what's happening in the dollar and diversifying from that, but also this idea of adding less correlated return streams to a traditional 60-40 portfolio, given that we've seen a couple of things happen so far this year. We've seen not just the idea of rate volatility coming back into play, but we've also seen inflation volatility come back into play as well. So the 40 part of that portfolio, when you think about fixed income and longer duration bonds, hasn't played that defensive job in as meaningful of a way. So folks are starting to think about alternative parts of their market and less correlated parts of their market. Gold is one part of that story. Real assets is another part of that story, is particularly within private infrastructure, but hedge funds as well, as people are trying to shore up their portfolios for likely what is going to be a new regime moving forward, which is moderating economic growth, elevated rates, so we still expect rates to come down, but land at an elevated level versus what we've seen in the prior decade, and elevated inflation levels.
That's interesting, especially when you talk about the 40 part of your portfolio. I think a lot of investors still have trauma from 2022 when you had the S&P 500 decline 19%. Bonds did nothing for you in terms of acting as a hedge. So when it comes to gold's performance this year, outside of what we're just seeing today, are you saying that basically it's taking the place of bonds? Is that the whole story?
Taking the place, perhaps not, but being a very valuable complement, yes, full stop. I think that there are parts of the fixed income market that we still like. They just tend to be shorter duration. Some parts of the muni curve, even on the longer duration side of that equation, still look good. But it's just that the conversation of what a resilient portfolio is looking like is starting to evolve as the regime and the macro regime is starting to evolve as well. Again, gold, but the real asset side of the equation too. Less of an either or conversation, but an and conversation on shoring up your portfolio.
What are the assets or what are the factors that you like? There's so much to talk about, right? Private credit.
Yes.
In terms of factors, M&A, I guess, is looking like it's going to pick up, or IPOs look like maybe they'll pick up. A lot of them have done well lately. What gets you excited?
What gets me out of bed in the morning?
Yeah.
So there's a couple of things. One, really pleased to see the pickup in capital market activity. When we look at global IPO and M&A activity, there was a pause post-Liberation Day given the uncertainty around trade, tariffs, policy uncertainty. But what we actually saw is May and June have been the strongest months when you look at global M&A and IPO activity for multiple years. And that's good for a couple of different reasons. One, it supports the thesis on the public markets for financials. But two, it gives a lot of credence to our expectation that exit activity within private equity markets is also going to start picking up, which has been a very big area and topic of discussion within private equity markets. And then finally, the other thing that gets me up in the morning is talking about a lot of the opportunity that we're seeing within infrastructure. We've been talking about this a lot so far this year because you have multiple pillars of that investment thesis. One, what we're hearing a lot from the hyperscalers, even this past earnings season, is that AI CapEx is continuing. But that AI CapEx is not just on the tech side of the equation, but it's on ensuring that the power generation side of that equation is there. That is secular tailwinds for the infrastructure side of the equation. And then two, when we think about the entire U.S. economy, but really the global economy, we're at a period of time where infrastructure age, the underlying age of infrastructure within the United States and globally, airports, tolls, roads are hitting 30, 40 years old, and they're reaching the end of their life cycle. So you have these really two strong secular tailwinds. And then again, when I talk about less correlated return streams, infrastructure plays that side of the equation too, because it provides inflation resilient income, which is extremely important in this market environment today.
Well, this conversation brings me back to that Meta deal that we learned about, picking Pimco, Blue Owl for that $29 billion data center deal. Sitara, we have to leave it there. Great to see you.
Nice
have a
to see
wonderful
you.
weekend when you get there. That is JPMorgan Private Bank's Sitara Sundar. Meanwhile, let's get a check on this equity market. We're just about 7 minutes into the session, and you can see we have fairly good breadth right now, almost 300 names in the green. But as Matt and I were discussing, we've seen this movie a few different times. We open higher, breadth is good, and then it deteriorates throughout the day. We'll see if this Friday is any different. But you take a look at what is lifting us up. Right now, it's all the names you need. Microsoft, Tesla, Palantir, Alphabet, et cetera. Those are your biggest contributors to that upside gain. I think the downside is really interesting this morning because Trade Desk is actually your biggest loser on a points basis as well. This company, I think it has less than $30 billion in market cap, which really tells you just how painful that 38% decline is if that is your biggest loser right now. Then it's followed by Amazon. That certainly isn't helping. Let's take a look at the sector breakdown as well. You'll see something similar. Actually, you have all 11 in the green right now. Healthcare up at the top, followed by financials, consumer staples, energy. The list goes on. Relatively contained moves when you get outside of healthcare and financials, but still, right now, it's a perfect score, Matt.
Yeah, very interesting trade indeed. We'll see if that turns around by the end of the day. We got a lot, as you said, of fascinating stories in tech that aren't really moving the shares, but we still want to pay attention to Tesla, for example, disbanding its Dojo supercomputer team. That talent is highly sought after. We'll take a look at the next steps for the EV, AI, and humanoid robot giant next. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Peloton getting an upgrade over at Goldman Sachs. The fitness company is projecting a sales decline for the quarter and said that it would cut jobs. But the company also expressed confidence in a turnaround plan under new management. Shares up by more than 5% right now. Next up, Monster Beverage is getting an upgrade over at Piper Sandler after second quarter sales surpassed expectations thanks to increased demand for energy drinks. And finally, Wall Street is weighing in on Crocs after the footwear maker reported a disappointing quarter and a weak outlook. Barclays and Stifel are cutting their recommendations on the stock, and you also have Goldman and BNP Paribas slashing their price targets. Crocs, for its part, up about 2% right now, Matt.
All right, so there's a look at some of the stocks getting calls. Let's turn to Tesla. This company is disbanding its Dojo supercomputer team, upending the effort to develop in-house chips for driverless technology. Joining us with more is Max Chafkin, co-host of the podcast Elon Inc. And Max, this was a huge push for Elon for a while. We didn't hear anything about it. We haven't heard anything about it lately because he's talking more about the AI5 and AI6 chips that I guess he's making with others. So this highly sought after talent is going somewhere else or has gone, right?
Right. So there's sort of two setbacks here. One is Dojo not working out, the way that Tesla had originally hoped. This was a training effort. So remember, there are two kinds of AI, essentially. There's training, where you develop the model, and then there's inference, where you actually run the model. This is the training part of it. And the idea here was to develop sort of a in-house solution, I think, to cut costs, to make it cheaper so they don't have to buy quite so many NVIDIA chips. Although we've heard basically for over a year signals that maybe this wasn't working out. Elon Musk in 2024 said they were pursuing sort of two tracks. He called Dojo this effort that shut down a long shot. I'd say the more significant thing is losing the talent. Like you said, we're in the middle of this, effectively a talent war for AI. Tesla's stock has been, as we know, not doing super well. So I think it's become harder, especially with all these other startups throwing huge amounts of money at engineering talent to keep AI engineers, in a seat.
Yeah, that talent war, you can definitely say that again, that it is fierce when it comes to the AI landscape right now. So where does this leave Tesla? Where are they refocusing their efforts even as they lose this talent?
So, I mean, this doesn't signal a change in strategy. Elon Musk is still all in on autonomy. You know, we're going to hear all about the robotaxi, this pilot effort that they're doing in Austin. You know, there's Optimus, of course. So I don't think it signals much of a change. It just is sort of like a setback because Tesla, throughout its history, has tried to, to make basically everything in-house. That's one of the things that Elon Musk is very proud of. And to have to rely, on these outside companies, especially NVIDIA, which has a ton of sort of pricing power, that's not great. That said, I don't think we should look at this as like a huge setback, but it is a setback.
All right, so it's a setback. It's not a strategy change necessarily, Max. Really appreciate your insight, your reporting there. That is Bloomberg's Max Chafkin. And be sure to listen to Max's podcast, Elon Inc. You can find that wherever you get your podcasts. But speaking about AI races, let's talk about the race for AI infrastructure also heating up in a big way. We learned that Meta has picked Pimco and Blue Owl to lead a $29 billion financing for its data center expansion in Louisiana. Here with more is Mandeep Singh. He is global head of tech research for Bloomberg Intelligence. So interesting news here. When you think about Meta's physical ambitions, we talk a lot about, of course, the talent war when it comes to Meta, but also expanding aggressively when it comes to their data center footprint.
Yeah, look, I mean, when it comes to these, hyperscalers, it's not just about having LLMs or the data. Right now, it is about having entire infrastructure. So when I say infrastructure, you need the land, you need power, and that's where, partnering makes a lot more sense because these companies, not only will they help with financing, I mean, Meta has talked about $100 billion capex for 2026, so clearly Meta is putting a lot of their own money, but I think having external financing does help with the other attributes like land and power, because the core competency for a company like Meta is in building applications, is in doing their own algorithms and LLMs. I think they are branching way beyond what they used to. And partnerships does make a lot of sense.
By the way, we're going to talk a lot more about this later on the program because we have Marc Ganzi from DigitalBridge, and he also runs some data centers. But I have learned so much from you and from Anurag and the conference that you guys put on. I knew already that there were two sides to AI, training and inference, because of you. Thank you very much. And I'm learning so much more jargon lately. Ed Ludlow wrote a story about a bunch of the guys that left Dojo. They're going to density AI, which is apparently coming out of stealth.
Yeah.
And coming out of stealth is a term that these tech startups use.
Not one that I've heard, so.
Yeah. I hadn't heard that either. I also heard yesterday that the surge in AI, especially GPT-5 level capabilities, is causing a lot more vibe coding. I thought it was a typo, but apparently that's a thing.
I'll give you one anecdote that was shared during this earnings season. Google's, tokens process, and token is how you consume generative AI, has 100x'd over the course of last 1 year. And we're talking 1 quadrillion tokens, which is 1,000 trillion tokens per month. That just goes to show how much inferencing has increased in terms of, the number of users. So ChatGPT now is closing in to 1 billion monthly active users.
Wow.
And that is how fast exponential this growth has been. And that's where the compute infrastructure that you need for GPT-5, for Google's LLM, for Meta AI, that's what's driving, this big build out, and it shows up in the consumption.
How much do you think, how much energy are we wasting, Mandeep? Like my buddy Ted Fine over here in TV was using his chatbot to draw a picture of himself flying over the Bloomberg building, and his daughter was like, "Dad, you're wasting so much energy." Is it really bad?
I mean, right now, look, the scale of compute has definitely magnified. And you could argue some of it is a waste because, it's not being used for productive purposes. Not everything is contributing to an enterprise use case. But that's where, compute, as we know, will continue to grow because it can do a lot more now. It saves you so much time. If you're a developer right now, you save so much time by using this coding agent. That's what they showcased with GPT-5 yesterday, and it's a real use case.
If only I were doing something productive.
If only.
Mandeep Singh, thank you so much for teaching us all of this. Mandeep runs our tech coverage at Bloomberg Intelligence. Coming up during a market downturn, are you turning to gold or to Bitcoin? Bloomberg Intelligence did the research on which asset is the better hedge, and we'll give you the answer next. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. Just about 22 minutes into the trade, you can see we're gaining now 0.5% on the S&P 500 up to 63.72. So approaching again that 6,400 level. Hopefully we don't turn around and tank by the time we get to the close. Some really interesting stuff in the individual movers. Well, actually, first, before we get there, look at the 10-year, 427, 428. So we had reset, to use, I think, Katie's terminology on Friday, but now we're floating higher again. NVIDIA is up right now. Tesla gaining, even though Dojo's getting broken up. The real, is it worth $1 billion now? It's a 25% gain, and I think it must be getting close to there. Under Armour losing almost a fifth of its value. This is where you got to focus in on. Gold up to $34.98, so trading at an all-time high here in the U.S. And Bitcoin right now down, but still at $117,000, Katie. That's a lot.
Yeah, just wild, especially when you consider where we were even a year ago. But Bloomberg Intelligence, they looked into whether the performance for gold and Bitcoin on S&P 500 down days, what that says about hedging properties of both asset classes. And they found that Bitcoin isn't as reliable as gold to hedge against downturns. Pleased to say that Bloomberg Intelligence ETF analyst Eric Balchunas joins us now. So basically, if the S&P 500 is falling, it's probably gold that's going to be your safety valve.
Yeah, generally, gold is zero correlated, right? And that makes it a great diversifier, but it's not that reliable either. I would say both are diversifiers. Gold better for a stock market decline. It's just got a better record. It's got a lower correlation. But Bitcoin's correlation is dropping, but it does move with the market. It's still generally a risk-on asset. We like to think that Bitcoin is more of a hedge against the global money printer long-term. It definitely moves in line with the monetary supply, right? That liquidity measure. So I think that's why people use it. They also like the technology. So it's just, yeah, don't think Bitcoin is going to hedge your stock portfolio. That's a good rule of thumb.
Well, yeah.
But gold is shaky too. It's better though.
Well, you hit on what I was wondering when I was reading this research, and that is anyone buying Bitcoin as a true hedge? I feel like you buy Bitcoin because you think it's going to go higher.
Yeah, Bitcoin is in the transition state right now. I've always said it's like gold is a teenager. It's 16 years old. It's literally a teenager, and it's volatile. But as it got financialized through the ETF and now corporations and governments, the volatility is dropping. Its volatility is now less than double gold. It used to be 3 times gold. So it's much more stable, and the correlation is dropping. But it's not where gold is. Gold's 4,000 years old, okay? It's like an ancient thing. So for Bitcoin to be anywhere in the ballpark of gold is pretty good. But again, I would still generally view Bitcoin as hot sauce at this point. It would be something to use in small doses around the portfolio until it keeps maturing and it gets into a gold level of correlation and volatility, which is not quite there yet.
Yeah, you just have to microdose it. Eric, really appreciate your time. Have a great weekend. That is Bloomberg Intelligence ETF analyst Eric Balchunas.
I wish I'd macro-dosed Bitcoin.
Bitcoin? Yeah. Well, you got close.
And by the way, I would have bought it as I saw, if I had courage and conviction, and if I thought it was ethical. As I saw the federal government just pouring trillions of dollars across the country.
You are speaking to a choir right now, and I hope that they're listening. But listen, tune into ETF IQ on Mondays at 12 p.m. New York time. I'm there with Eric Balchunas. I'm there with Scarlett Fu. It's very fun. You can also read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter.
What a great newsletter that is.
Thank you for saying that.
Absolutely love it. Coming up in the next hour, we're going to speak with Michael Saylor. We're going to speak with Marc Ganzi, as well as Paisley Nardini. We are 30 minutes into the trading day, and you're seeing gains on equity indexes and the U.S. 10-year yield rises as those bonds sell off. So investors moving out of treasuries into stocks. They're bullish into the weekend, at least for now.
Never trust a morning rally, Matt. That is what I've been saying for about an hour now.
She's Katie Greifeld. I'm Matt Miller. This is Bloomberg Open Interest. And coming up,
boy, do we have a show for you. A tariff surprise. Gold futures jumping as the U.S. confirms it put levies on imports of bullion bars.
on the corporate front, 10 stocks have driven 80% of the S&P's rally since Liberation Day, and we're almost done with earnings season.
Plus, private equity, crypto, and other alternative assets are coming for your 401ks. Details on that plan ahead.
All right, let's begin with the U.S. unleashing fresh turmoil in the gold market. It was confirmed that 1 kilogram and 100-ounce gold bars are subject to reciprocal tariffs enacted by President Trump. Joining us now is Bloomberg's economic statecraft reporter, Joe Doe. He's our metals master here on set. Great to have you. This was, I think, a shock to a lot of people. And obviously, some people knew this was going to happen because they were front-running it for months. But for others, I think a shock that we actually went there.
So there was a lot of back and forth in the gold market in the months leading up to this moment, right? That there was initially a worry that, oh, the gold bars will be tariffed. And then there was a broad feeling, no, they would not be. A letter was seen by Bloomberg and other outlets that said, hey, in fact, there was a clarification asked out of Switzerland for what does the tariff actually cover? And the CBP, Customs and Border Patrol, said, well, actually 100-ounce and 1 kilo gold bars count. Now, those are the bars that go into all of the CME's warehouses. Those are the underlying for the futures traded on the COMEX, which is the world's largest futures contract for gold.
We saw the letter, actually, earlier. Jan-Henrik Forrester, our bureau chief in Switzerland, held it up
to the camera. Yeah, it was pretty cool. I have to think about the trader angle here. I mean, you think about what an international market gold is. You think about all the different warehouses around the world. Is there any opportunity for arbitrage right now, or are people just really trying to get their legs under them?
There was an arbitrage trade. We did hear of a number of traders in the months leading up to this who had started sending gold bars into the United States to catch the premium. Now there's an obvious premium. If you're, we had a chart earlier in our story today that showed the premium's well over $100 per ounce, I believe. You know, I think right now there's just a lot of confusion in the market. Everybody's wanting some sort of clarification. Some people have surmised that maybe this was a mistake. But listen, when you ask for a clarification from CBP and they say, yes, this is the clarification that we're giving, I think for the moment, this is how the market has to operate, under the assumption that it does in fact exist. And that is why we're seeing the moves in the market today that we've seen.
You have to imagine someone is going to make money here, or potentially lose a lot of money betting on that premium to collapse.
Listen, I've covered trading in the metals, physical metals markets now for over 10 years. Yes, the answer is yes. People will try to make a dollar, right? I mean, in some ways, this is a bit of a trader situation. Now, of course, big banks, so central banks, are constantly moving gold bars from their own to across the ocean. I mean, you guys might remember 5 years ago when COVID hit, there was a big scare in the gold market, right? Because gold typically, when it travels between central banks or bullion banks in different regions, it flies in the bottom of commercial aircraft. And so when commercial aircraft were grounded, we had a massive concern of the ability to move the underlying from one place to another. It is always, to me, striking to think of gold as actually existing and having underlying. It's a paper traded market, right?
Central banks aren't shifting around 400-ounce blocks of gold on the regular.
I mean, listen, they have trading desks, right? And there is a bit of trading activity, but you know, typically it's like, here's the paper, right? And you don't think of actual gold going from one bank to another, traveling over the ocean, but that's what we're seeing here. This is why this trade is happening. The physical still matters.
It's the same conversation in ETFs, because you have all these physically backed ETFs. They have to actually buy gold and store it underground. So the tentacles here are vast.
Yeah, what an awesome story. What a great industry cover. Joe Doe, thanks for joining us. Joe, is probably going to be on television and radio throughout the day. Also, coming up later on, we have the head of precious metals over at HSBC, James Steele. He's going to join us and wade through the details that we get between now and then. So be sure to tune in for that. And then on Monday, we'll be joined by Marc Bristow, Barrick Mining president and CEO, to talk about the angle from a guy who brings this stuff out of the ground. Right now, let's get over to Paisley Nardini, head of multi-asset solutions at Simplify Asset Management. And Paisley, multi-asset, the key here, because we obviously want to get your take on gold. Even without this premium, it's trading at a record high. How much gold should one have in his portfolio?
Yeah, well, happy Friday. Thanks for having me. I love the topic of gold this week. Commodities are near and dear to our heart at Simplify, and we have several strategies that think about investing in gold, either long only or long short construct. And I think this is another example of how some of these tariff announcements continue to add volatility to investor portfolios. I think over time, gold has acted as a strong hedge, and we talked about that earlier today on the show, and thinking about hedging against equity risk and just kind of all-out fear in the marketplace. So any allocation, say around 5, even up to 10%, is typically what we might see in an advisor portfolio. But the way we think about it is really combining it with a broader kind of strategy approach and thinking about long, short commodities, and gold is one component of that.
So would you recommend adding gold here, though, with all these question marks, but you add them all together? It seems like the price of gold is going to go even higher here if these tariffs truly stay in place. And we were already near record highs on gold.
Yeah, great question. I would say coming into this year, we were pretty bullish on gold for several reasons. I think equity markets were hitting all-time highs, as they are again today. Thinking about some of the foreign buyers, the central bank buying globally, I think that underpins the price of gold, continues to add to those tailwinds. And looking forward, something that I'm focused on is these bouts of volatility. As we think about tariff announcements, as we think about supply-demand mismatch, and as we think about some of the central bank policy, especially within the US here, as we start to think about rate cuts, all of that really instills volatility and uncertainty in the market. And I think gold is one of the purest plays to think about how you can hedge against that uncertainty.
Yeah, by the way, one of the stories we haven't brought up yet is Japanese car exports. I think everyone pretty much thought they were going to be tariffed at a 15% flat rate with everything else. And we learned today that actually the CBP was still stacking tariffs up to 27.5%. The Japanese had an agreement with the Trump administration, but they decided not to write it down. So now they've got to backpedal a little bit. All of these deals seem relatively uncertain, Paisley. Why doesn't the market seem to care too much? I mean, benchmark indexes continue to rise, with the exception of the small caps, to all-time highs.
Yeah, I don't know if the phrase taco is still relevant. The Trump always chickens out.
I tried it yesterday, but no one likes it anymore.
Yeah, it's not Tuesday, but we can talk about tacos. I would say bigger picture, we've seen a lot of back and forth. We've seen, markets digesting headline news and then a lot of that backing off either throughout the day or over the course of several weeks. I think the markets are always looking forward, right? They're not thinking about today. They're not thinking about next week. They're thinking about 6 months from now, 12 months from now. And I think what we've determined is that a lot of this tariff news is kind of settled. That's not to say we won't continue to see headline risk. I mean, just even a week or two ago, we saw what happened to copper prices. And so as we think about, auto industry, thinking about imports, thinking about the impact that tariffs may have, I think that word uncertainty just continues to linger. But I think markets and investors are really looking forward and focus more on rate cuts, thinking about employment data here in the U.S. And underpinning all of this, though, is just the resiliency within the corporate market. And we saw earnings meaningfully outperform in the last couple weeks.
All right, Paisley, thanks so much for joining us. Paisley Nardini there, Simplify, head of multi-asset solutions. We have breaking news right now on the geopolitical front. Sources telling Bloomberg that President Trump and Russian President Vladimir Putin are planning a truce that cements Russia's gains in Ukraine. So we did know that President Trump, of course, wanted to meet with Vladimir Putin, and there was a lot of talk about the fact that they could do that meeting, the leaders of Russia and the U.S., without the leader of Ukraine present. Vladimir Zelensky wouldn't have to be there. And the worry, of course, Katie, is that if they did that, obviously President Trump wants to end this war.
Right.
President Putin wants to keep the ground that he's gained in Ukraine, and if Zelensky's not there, maybe they just agree to end it and divvy up the country.
Right.
And now we're hearing that indeed this truce being planned will cement Russia's gains in Ukraine.
Well, taking a look at our reporting, this is according to people familiar with the matter. Washington and Moscow aiming to reach that deal to halt the war in Ukraine. That would lock in Russia's occupation of the territory that was seized in its military invasion, as you said. Putin demanding that Ukraine cede its entire eastern Donbas area to Russia, as well as Crimea. Remember, his forces illegally annexed that in 2014. Let me stress again, this is according to people familiar with the matter. Let's turn now to Bloomberg's chief political correspondent and surveillance co-host, Anne-Marie Hordern, joining us on set. So this news just coming across the wire. Anne-Marie, what do we know so far?
So basically, I think it's a first step in the contours of a deal. I think what's really important here and to stress is that this is amongst conversations right now between the United States and Russia. And we don't have any indication just yet if Zelensky would sign off on this. But what this would mean is Crimea, which most people have assumed that would stay within Russian territory, annexed in 2014. Putin is demanding also that Ukraine cede its entire eastern Donbas area to Russia. This is where it could be very complicated for Kyiv, because that would require Zelensky to withdraw troops of parts of Luhansk and Donetsk that Ukrainian troops now have control over. And then there's also questions of places like Kherson and Zaporizhia. Right now, Russia would have to halt its offensive there where they are. What does this mean for Zaporizhia specifically? Because that is the biggest nuclear power plant in Europe. But I would say that this is just giving contours of potentially what could be agreed upon when Trump and Putin meet. It looks likely that they could be meeting as soon as next week. I think it's important to note two things on this, though. Yesterday, the White House was pushing back pretty strongly after the Kremlin came out and said that they did agree that they were going to have this meeting. And the White House is saying there would be no meeting unless Putin sat down with Zelensky. Then the president was asked directly about this by reporters. Does Putin need to meet with Zelensky before or in order for you to sit down with Vladimir Putin? And the president was very quick and decisive, and he said no. So it looks like whether or not Zelensky is going to have a one-on-one with Putin, whether this means a trilateral, President Trump looks like he wants to sit down with Vladimir Putin.
By the way, we do see oil, and we're showing it on the screen, falling after it had been gaining earlier this morning. The drops aren't severe, but a little bit more than 1% for both NYMEX and the global benchmark Brent crude. What more do we know about this meeting? I mean, where would they meet, for example?
So that's a good question. I think you have to look at places where they met in the past. What would be on the list? What would be off the list? Helsinki, no longer on the list, as Finland has joined NATO. I think Switzerland, given the fact that I think Russia no longer views Switzerland as a neutral territory, that would be off the list. So I would look to the Middle East. I mean, yes, it's August. It's not a prime spot usually weather-wise to go there. But the Middle East, the president has already visited the Middle East. He does view the Middle East, Gulf countries like Kingdom of Saudi Arabia, Qatar, and the United Arab Emirates as places where he can do business. I would note he's already been there, so already there's been advance work that's been done there. Also, the ruler of UAE, Sheikh Mohammed bin Zayed, was in Russia yesterday meeting with President Putin. So personally, for me, reading the tea leaves, I would say likely it could be a place like that. Maybe the Kingdom of Saudi Arabia, given the fact that Saudi Arabia was one of these first places that hosted the United States negotiators and Russian negotiations in the very beginning.
By the way, you are perfectly poised to cover this story because, okay, you spent a lot of time with President Trump now. You've spent some face time with Vladimir Putin as well. But you also spent years covering OPEC. And oil plays into this so strongly. It does seem like the production increases that OPEC has given the world recently have allowed President Trump to really turn the screws on Russian oil buyers like India, for example, without driving the price up. And of course, we see the price now coming down because with this agreement, would this truce then free up Vladimir Putin from other sanctions and let him sell more oil into the market?
Well, that's a big question. Yeah. What happens now with all the sanctions that are placed at Russia? Not all these sanctions are coming from the United States. Where is Europe in terms of this conversation? What happens to the sovereign frozen assets? That was a huge hit for Putin and his ability to conduct this war. So there's still a lot of questions at play. I think the market is viewing this as, if this is a potential first step to an agreement, why would the United States put those secondary sanctions that the president has been talking about on Russian oil, basically going after the buyers of Russian crude? You mentioned India, but also the biggest buyer, of course, being China. Reading the tea leaves again, President Putin spoke this morning with Xi Jinping. And when you look at the press readout in China, Xi Jinping really implored on Putin that he was happy with Russia talking to the United States. So the oil market is viewing this as those sanctions likely would not come into place. Remember, it was a deadline today the president set for Putin to come to the negotiating table, or he was going to use secondary sanctions.
All right, Anne-Marie Hordern covering this breaking news for us. Thanks very much. Again, we're learning from people familiar that truce could be in the works that would allow Russia to keep a lot of the territory it's taken in Ukraine. That could happen in talks between President Trump and President Putin. Coming up, we're going to get back to AI. DigitalBridge adding new platforms to its infrastructure. We speak to the company's CEO, Marc Ganzi, next. This is Open Interest. Let's get out of high interest. Look at what's making headlines around the world. President Trump will nominate Stephen Miron for a seat on the Fed's Board of Governors that expires in January. It's Adriana Kugler's seat. Miron supports Trump's push to cut rates. His nomination is seen as a signal of what the president wants from the central bank ahead of his choice to succeed Jerome Powell. But we all already know what the president wants. Tesla is disbanding its Dojo supercomputer team. The move upends Tesla's efforts to build an in-house supercomputer for developing driverless vehicle technology. The EV maker plans to increase its reliance on external partners like NVIDIA and AMD for its AI5 and AI6 chips. And the race for AI infrastructure is heating up. Meta has selected Pimco and Blue Owl to lead a $29 billion financing for its data center expansion in rural Louisiana. Pimco would do $26 billion of debt. Blue Owl would do $3 billion of equity. For more on the race for data center infrastructure, let's talk to DigitalBridge CEO Marc Ganzi, because DigitalBridge already controls one of the largest power banks in the market. And Marc, you've been running data centers for quite a long time. So what kind of assets are these? I've been looking at your revenue and it just goes up and to the right. I've been looking at your bottom line and now you're turning a profit. What kind of margins are you getting on data centers?
Well, Matt, it's been a great business. It'll continue to be a good business. I think the headline coming out of the quarter for us was, good results, solid results. We beat on revenue, we beat on FEEM, we beat on FRE. And so third quarter in a row where we delivered what the market wanted. And the subtext behind that, the way we're getting there, is exactly what you said, which is continuing to commit capital to the AI economy. And so we've got $43 billion of in-flight construction right now across over 100 different projects and data centers. And across our 8 platforms that we own and operate around the globe, we do have a really substantial power bank, as you highlighted. We're at over 21 gigawatts of on-demand power for our customers. This is a power bank that is really unrivaled in terms of its size and scope. And so we've been at it for, as you know, Matt, over 10 years. So it gave us a chance to get a little bit of a head start in terms of getting the right land, the right CEOs, the right platforms. And I think investors are flocking to data centers because they see great stabilized returns. You're seeing returns on an unlevered basis, Matt, between 7 and 9.5%. And once you add, securitized leverage to that, you get really attractive returns, which is why you see so many investors piling into the space in the last 24 months.
Well, and your assets under management just continue to grow. Your eclipse now $100 billion, and CapEx continues to grow as well. I mean, how often do you have to move the bar higher and higher, right? You're going to spend, what, $40 billion in CapEx next year?
Yeah, so between now and the end of next year, we've committed $43 billion of CapEx. And by the time you and I talk in the next 90 days or whenever you and I get together, that number will go up. I can pretty much be assured that that number will go up for us. And so to do that, we have to keep forming capital. And one of the big themes out of this quarter for us, Matt, was our ability to form capital to the AI economy. So we stayed right on target with our fundraising and our flagship funds. We've introduced a bunch of new strategies around digital power, which we're excited about. And then, of course, we hit the credit markets. Two of our most valuable franchises, Switch and Vantage, combined up, hit the credit markets. We raised $10 billion for Switch, $9 billion for Vantage. That's $19 billion of committed debt financing to continue to build these AI gigafactories, these ultimate LLMs, and obviously inferencing too. We're doing a lot of work in terms of edge compute and inferencing right now, Matt. That's a big trend coming out of the quarter. And obviously you heard that from one of your speakers before at the amount of tokens that some of our customers are processing now.
Well, in the context of CapEx, I'm taking a look at the notes that you sent over to our producers, and you make the point that AI is becoming an ROI story. I've heard variations of that phrase a few different times during this earnings season. What does that mean specifically to you?
Well, look, for us, we need healthy customers, Katie, right? Those customers have to produce earnings, and it requires a little bit of patience. And what we are seeing is the revenue model for AI is accelerating. And that's really from going from LLMs into inferencing. And inferencing is where all of these hyperscalers are going to make their money, because those are actual models, language models that are being put to work, workloads that are happening in the enterprise, workloads that are happening from data sovereignty perspectives, machine-to-machine connectivity, and ultimately the proliferation of this data traffic to mobile devices, which creates a whole nother revenue line for these hyperscalers. So the return on invested capital in public cloud, Katie, took 5 years, and we're 13 years into building the public cloud. We're seeing the monetization of AI. We're probably 2 to 3 years into the construction of AI infrastructure, and we're already beginning to see positive returns from some of our customers. And it's important that they make money so that they can keep investing the CapEx. And I think that's one of the themes you're seeing out of the quarter, is that these folks are starting, our customers are starting to see a faster return on invested capital, which is why CapEx has gone from $250 billion to $300 billion, now to $380 billion in CapEx being spent in 2025. It's an absolute arms race.
I want to say, how easy is funding for you? Because you must be the most popular guy at every cocktail party, right? Private credit, private equity, they all want asset-backed loans. And we see equity coming out of Blue Owl. I mean, what kind of phone calls are you getting, Marc, to do these deals?
Well, look, first it starts with a foundation of having great LPs, Matt. And I think one of the things we've done at DigitalBridge really well is cultivate our over 300 LPs across the globe that are invested in our products, whether it's our flagship fund, our credit funds, our continuation funds, and of course our new digital power strategy, which has been, since we announced our partnership with ArcLight and closing our first deal with Taknok, which is a powered land solution for our customers, everybody wants to be at that fulcrum or that intersection, Matt, of where AI meets power. And that's the next big thing. You know, you and I started talking about that last fall at Bloomberg Invest. Where are we going in terms of power? How are we going to power the AI economy? That's really the nerve point right now for our customers, is how do we get out there and build grid independent solutions, Matt, that ultimately can circumvent that critical function that's happening right now, which is our grid is candidly is at capacity right now. So we've got to go out and we've got to build alternative power solutions. We've got to build them fast, and we're doing that already. We've been at it for 2 years now.
All right, that's a good place to leave it. Marc, really appreciate you taking the time. That is Marc Ganzi of DigitalBridge. Now, more ahead on AI investing. Next hour on Bloomberg Tech, we'll hear from OpenCap AI COO Brad Lightcap. Looking forward to that conversation. Let's quickly check in on oil here, dropping after Bloomberg News reported that the U.S. and Russia are planning a deal that would cement Russia's territorial gains during its military invasion of Ukraine. Of course, you can see the oil market digesting that news. Not too big when it comes to the percentage loss, but still certainly a direction change.
A little bit of turnaround there. We're seeing so many cross-asset moves. Your team on the other side of the office must be on fire today.
Yeah, it's been a busy couple of weeks, busy couple of years. Coming up next, we're going to talk digital gold with Strategy Executive Chairman Michael Saylor as his company buys more Bitcoin than ever before. This is Open Interest.
President Trump signed an executive order easing access to private equity, real estate, crypto, and other alternative assets in your 401k. Bloomberg private equity reporter Allison McNeely did this story and is here to tell us all about it. So this is something that I think a lot of people in the industry that you cover and many others have been waiting for. And it essentially gives investors, or I should say consumers, access to things that a lot of retirees or future retirees already have access to. For example, if you have a fund run by CalPERS.
Yeah, so really it's a long anticipated executive order that essentially directs the Department of Labor to look at whether or not they need to reevaluate guidelines, work with other government agencies to potentially change rules to essentially make private assets, alternative assets such as private equity, real estate, crypto more accessible to individual savers. Technically, there's nothing stopping a corporate pension or a corporate 401k plan administrator from putting those assets in their lineup right now. But a lot of companies are really hesitant to because they're afraid of getting sued because the guidance around this and these assets hasn't been that clear in the past.
Interesting. And, I'm just surprised that we're in a world where you see crypto getting added to 401ks before ETFs, but I do digress. Let's talk a little bit more about the opportunity set for crypto, because this is something that a lot of actual, real places have been talking about for a while. Fidelity, for example, has been pushing for this.
There has been some, depending on who you talk to in the industry, sort of behind closed doors and private conversations, there is some sort of difference of opinion in some corners of the industry about whether or not crypto should have been included in this order or not. Some folks would like to keep alternative assets like private equity, private credit, more separate from crypto, but others say, you know what, they should all be included because fiduciaries, the people who are responsible for selecting investments to put into a lineup, they should have, free reign to do what they do, which is make, prudent choices for their constituents.
All right, Allison, great reporting as always. Appreciate your time. That is Bloomberg's Allison McNeely. And let's keep this conversation on crypto going because so-called digital asset treasury firms have announced plans to raise a combined $79 billion so far in 2025 just for Bitcoin purchases, according to advisory firm Architect Partners. But that trend is expanding into smaller tokens as well. And I'm pleased to say that joining us now is Strategy Executive Chairman Michael Saylor. So, Michael, it feels like, of course, MicroStrategy, Strategy as it's now known, really started this crypto treasury company trend that we're seeing now. I know that you broadly are supportive of seeing competitors come out and also raise their own crypto treasuries. But how do you feel about the trend that now it's moving more into altcoins? It's moving away from Bitcoin. Do you think that that's a sustainable setup?
I still think the vast majority of the capital flowing into the space is flowing into Bitcoin. We've gone from about 60 companies capitalizing on Bitcoin to 160 companies just in the past 6 months. So I'm laser-like focused on Bitcoin. I think Bitcoin is digital capital. I think it's going to outperform the S&P index over the indefinite future. And I think it's the clear global monetary commodity in the world right now. So it's the lowest risk, highest return, most straightforward strategy if you want to outperform the S&P and if you want to inject vitality and performance into your balance sheet.
So it sounds like you're not concerned that perhaps the fact that we're seeing these other digital asset treasury companies come to the fore here, expand into altcoins, you're not concerned that that's going to detract attention away from what Strategy is doing?
I think there's an explosion of innovation across the entire crypto economy, and on the margin, it's really good for everybody in the digital asset space right now. I think the big idea is $100 trillion plus of capital in the traditional equity capital markets and traditional credit markets. And what we're focused on is delivering digital asset-backed equity and digital asset-backed credit. And I think those credit instruments and equity instruments are just going to outperform the traditional fiat credit and traditional fiat equity instruments all around, and capital is going to flow into the digital economy due to that.
Michael, explain the assets, the unique assets to which you offer investors access, because it's not just Bitcoin treasury company, you think, a unique selling point compared to others trying that strategy?
Yeah, the real compelling idea of a Bitcoin treasury company is we hold a huge stack of Bitcoin, about $74 billion worth of Bitcoin. Bitcoin's a 21-year duration asset. You got to hold it for 21 years if you want the full potential. And it's about 50 vol and 50 ARR. Most people don't want that amount of volatility, even though it's got that performance. And who wants to wait 21 years? So what we've done is we've created structured Bitcoin in the form of Strike, STRK. We give you the Bitcoin upside, a guaranteed dividend, and principal protection, and that's an alternative for people that don't want the roller coaster. We've created a long duration senior credit instrument called Strife. Think of it as a 21-year Bitcoin-backed bond. Pays about 8.5% dividend yield right now for people that just want that quarterly dividend yield and a seniority in the capital structure. And then you've got a high yield long duration instrument called Strife. It's actually paying like 11.5% dividend yield right now. And so that's for people that want high yield forever. And they'd rather have 11% quarterly than take that's guaranteed than the roller coaster of Bitcoin. And then the most exciting thing we've done just a few weeks ago, it's the biggest IPO of the year. It's called Stretch, STRC. And STRC is like a monthly Bitcoin-backed bill. And so think of it as a Bitcoin alternative to treasury bills or money market funds. It's 9% dividend yield, monthly cash pay. And if you just want to park short-term cash and get paid 9% dividends and have it powered by Bitcoin, you're not taking duration risk on the interest rate. You're not taking the Bitcoin volatility. And that's our most successful offering to date.
Well, Michael, I do want to talk a little bit more about your financing. You touched on it a little bit. One of the other trends that you've started is issuing convertible notes to fund your Bitcoin purchases. You've also been issuing preferred stock as well. When it comes to just straight MicroStrategy shares, we know that's very popular with retail. We know convertible notes have been popular with more of the Wall Street crowd. Do you have any insight on who the end buyer of your preferred stock is?
Well, right now we've had really extraordinary demand from retail. In our last offering, I mean, we started with about 30 or 40 million of retail demand on the first preferred, and then it increased to 60 million on the second preferred, and then 120 million on the third preferred, and about 600 million on the fourth preferred. So retail's off the charts. We've also got a lot of institutional long investors, people that are holding. Look, if you like Bitcoin or if you like MSTR, these are all pretty compelling for any pool of capital you've got. And then, of course, a bunch of hedge funds also got very excited about this. There's lots of different ways to trade these against each other. So a good mixture of institutional as well as retail investors buying into all these preferreds.
And Michael, I'd also love to get your thoughts on some of the other big news from today. A lot has certainly happened on this Friday, but one of those is what's going on in the gold market right now. You have the Trump administration ruling that gold bars will be subject to tariffs as well, these reciprocal tariffs. So imports of gold will be tariffed. And that's really sending shockwaves through the gold ecosystem. Gold and Bitcoin are also often compared to one another. Bitcoin called digital gold, for example. I wonder if you think this has any ripple effects, positive or negative, for Bitcoin.
It does. Bitcoin is digital gold. It's going to accelerate the migration of capital from physical gold to digital gold. Bitcoin lives in cyberspace, no tariffs in cyberspace. The big appeal of Bitcoin is it's not physical. It doesn't have weight. You can settle anywhere with anybody in a few minutes. And so gold has always been too heavy, too slow, and you can't really ship it across an ocean. And if you do, now you're getting tariffs. So I really think it just reminds everybody why the digital version of gold is better than actual physical gold. And I think it's going to catalyze a new wave of institutional adoption of Bitcoin.
All right, crypto is stateless. It's hard to tariff. Michael, have to leave it there. Really enjoyed speaking with you, though. That is Strategy Executive Chairman Michael Saylor. Meanwhile, let's get a check on these equity markets. You can see that the S&P 500 extending gains right now. We're now up 0.7%, Matt Miller, and you can see it's big tech that's leading us there with the NASDAQ 100.
Yeah, and Tesla also at a session high right now. Probably not because it disbanded its Dojo supercomputer team, although that must save some money. Tesla has secured a Texas rideshare permit for its robo-taxi business, and I guess I know that's one of the places that the bulls have really pinned their hopes. That
Absolutely.
And humanoid robots.
Yeah. So you can see that's sending Tesla shares higher. That's certainly helping out the broader index. Sweetgreen just getting really hammered today, down 27%. That's after it slashed its sales guidance after a second straight quarter of disappointing results, highlighting the salad chain's struggles to sell $15 salads to budget-strained diners.
You know what I'm going to say, right?
$15 would be a bargain.
Would be great, right? I mean, I get salads there all the time, and I wish they were $15.
It
would
is just nuts.
Save some money. Expedia raised its full-year sales target after reporting strong second-quarter bookings fueled mainly by, well, its enterprise business as well as improved demand from consumers. So that's all, right?
U.S. consumers.
So I guess anyone buying tickets is fueling business there, and the shares are up 5%.
5%. Now, coming up, recent college grads are struggling to find jobs. Wall Street Week explores why that is and how AI is contributing to unemployment figures. That's up next. This is Open Interest. Time now for our Wall Street Week conversation. The unemployment rate for recent college grads has been above the rate for all U.S. workers over the past few years. David Weston dives into how artificial intelligence is cooling the market for entry-level jobs.
Recent college grads may be having a harder time right now finding their first job, but it depends in part on what kind of job they're seeking. Entry-level jobs in the areas Tiffany and Jacob want, tech and finance respectively, turn out to be particularly hard to find.
A lot of my peers who were in years advanced from me and trying to give me insights on how the process worked, all either had internships or were in the process of getting them or had full-time offers. And these are sometimes people that are just juniors who have a full-time offer at a bank or a different firm. And I think with my graduation class, there's been a pretty drastic change. I'd say about 50% of my graduating class is unemployed.
I see a lot of job descriptions that are asking for like 2 years of experience or like 3 years of experience. And in design specifically, it's been pretty hard. I think it's just a very saturated field and there's a lot of talent out there.
Tech is one of those that has been really slowed down. A lot of that comes down to the hiring boom that they did post-pandemic and them looking to right size. You also have other mathematical occupations in finance, legal, some of these fields that you would, again, have been in high demand over the last couple of years that just aren't seeing as much.
Economists say the reasons can be difficult to trace. Some of it is likely the overall labor market cooling after the post-pandemic hiring surge. But now there's a new cause coming on the scene: artificial intelligence.
AI will leave a lot of white-collar people behind.
All junior-level jobs in any industry are at high risk.
This is like a tsunami hitting the labor market.
For months, economists and executives have been raising concerns about AI or publicly embracing it, sometimes both. Amazon CEO Andy Jassy wrote a note to employees in June saying that AI would change the way work is done at the tech giant and that jobs would be cut as AI increased efficiency. Anthropic CEO Dario Amodei told one news outlet that AI could potentially wipe out half of all entry-level white-collar jobs and send unemployment rates surging. We may not be seeing anything quite that bad yet, but AI's impact does seem to be showing up in unemployment figures for recent college graduates.
I think there is definitely a link between the two. It's hard to parse through and just say, X amount of this issue is because of AI, X amount is because of just slower demand overall. But when we look at the numbers, there definitely could be a connection there.
That was David Weston on how AI is impacting entry-level jobs. You can catch Wall Street Week every Friday at 6 p.m. New York time. Now, coming up, gold bars are now subject to President Trump's reciprocal tariffs. We'll take a look at the impact on the market next. This is Open Interest.
The U.S. is unleashing fresh turmoil via tariffs, this time in the gold market. It was confirmed that 1 kilogram and 100-ounce gold bars are subject to the 39% tariffs President Trump put on Swiss exports. Joining us now is Mike McGlone, senior commodity strategist at Bloomberg Intelligence. And Mike, this is important because Switzerland is one of the main hubs for gold refining, and any of that coming to the U.S. already near record highs is now subject to 39% tariffs.
That is, yes, Matt. Do we know how certain that is? That's the problem. And it's what happened with copper. Everybody saw what happened. The big difference, though, is we're talking about the gold futures versus the actual physical contract. And futures always have to trade with the premium, and that premium just reflects interest rates. It's how you measure the price of a future. It's the cash price plus the carry. The carry is a T-bill rate. So that carry is getting a little bit high right now. The front contracts are about 2% above the cash. That's not that much. The question is how much higher it goes, but we're seeing that pull in a bull market. And the question is what stops it. I think it's just part of bull market. But the whole tariff thing, after what happened with copper, I think a lot of traders are just sitting back and saying, yeah, I'll put on a short-term trade, but I have to be very careful with this one because you don't know if they're going to come back. And by the way, they're 100-ounce bars. You can always take a 400-ounce bar, melt it down to 100 ounces, and deliver it into the COMEX contract. So it's a lot of uncertainty. But
and you can do that at home, melt those gold bars. But Mike, you touch on what I am really interested in, that anytime you see some sort of premium, some sort of big dislocation there, you have to imagine that traders are getting pretty interested here, that there's some potential to make or potentially lose money.
They'll make or lose money, but I really enjoyed having Michael Saylor on before. I interviewed him in Miami in 2022, and we were both very bullish Bitcoin. But the key thing I like to point out now is gold and the price of Bitcoin have been about the same for almost 4 years now. And this year, gold is way outperforming Bitcoin. So I think what's happening is we're seeing a major shift towards that old guard, stable, low volatility asset that actually has a negative correlation to the stock market versus that other asset, which is at a high correlation to the stock market. The thing about gold that's happening here is I think it's just the next iteration of what gold just absolutely loves about Mr. Trump. His Mercurial attitude, his pushing back in BLS statistics, his pushing back on free market capitalism, pushing back on the Fed, and now tariffs. It's just adding to that bull market that you're seeing from Trump and tariffs. And the question is where it stop. And that's why I think it's just going to get gold to that next key level, which is around $4,000 an ounce.
Can gold continue to rise if we don't have inflation, Mike? And obviously, a lot of people do expect inflation to continue or to start to rise again because of tariffs. But if that doesn't happen, does gold lose a little bit of the wind from its sails?
I think, Matt, I think it's our hair connection. It's an absolute right question. People are buying Bitcoin because they're expecting that last big trade of inflation to kick in. The next big trade, I think, will be deflation. Look at China. That 10-year yield is at 1.7%. Seen this happen in Japan before. It's deflation always follows inflation. To me, that's why gold's kicking in. And there's only one key thing that's preventing the whole world from some normal deflation after the inflation, and that's that U.S. stock market at 2 times GDP, the highest ever versus the rest of the world. If that just gives up a little bit, gold's off to the races. To me, now it's more about deflation. But yes, and certainly in terms of dollars and other currencies that are melting, sure, gold's always going to be your inflation hedge.
It's interesting, and this is something that I've been wondering about. What is the investment case? We were talking about the trader's case for gold, and it looks pretty ripe for opportunity right now. But what is the profile of gold in this cycle? Because even before today, we were hovering near record highs for gold. It's had an incredible run. Is it a hedge at this point, or are people going to gold for sort of more offensive opportunities right now?
I think it's more store of value that can protect yourself. So one thing, Katie, that most people don't realize now, the total return of the S&P 500 gold has been the exact same since 2017. And this year it's blowing everything away. So the rock is beating stocks now for, 8 years? The question is, how long is that going to last? And is it going to accelerate? That's why I point out, I think what's happening is this gold is potentially front-running a potential drawdown in the U.S. stock market. Gina Martin Adams says we're in a mania mode. Who knows how long that can last? And also you're seeing significant inflows into gold ETFs. For the first time in 4 years, gold ETF inflows are significant, up 10% this year. So there's that shift. And it's just about also, it's on the back of central bank buying, the deepest pockets on the planet have been buying gold. So I think gold is much better upside in the future, at least potentially during the Trump administration, particularly if we see a little back and fill in the most expensive stock market by some measures in a century.
Mike, I wonder what you think about oil. It was up this morning. Now it's down as the news crossed the wire that maybe Trump and Putin in a meeting will agree a truce. Where does oil go from here? Because it seems to be stuck in this $60 range.
$40 a barrel. It's a matter of time, Matt. I don't know what stops it. We have an oversupply on a global basis. We have a glut in the U.S., and we potentially declining demand. I made the call a few years ago. People have heard it from me before, but it's not profound. Crude oil has bottomed for around $40 a barrel for about the last 20 years, 3 times. And what stops that is a key question. The key thing that could accelerate is if we get a little back and fill in the stock market. So here's my key levels. I think crude oil at some point is getting down to 40. That needs to shut off those excesses of supply and demand, and then it'll reset. And I think at some point, gold's going up to $4,000 an ounce. And then one little trigger for that was just a little bit of lack of resilience in the stock market, maybe just a little back and fill. The stuff that we used to see in the past.
Right. All right, Mike, got to leave it there. Really appreciate your time. That is Mike McGlone of Bloomberg Intelligence. And be sure to tune in on Monday. We will be joined by Barrick CEO Marc Bristow. Really looking forward to that conversation.
I'll watch
Have a great weekend when you get there. This is Bloomberg.